All right, so I welcome you all once again to today's class. In today's class, we're going to look for what you call government grant, and government assistance. So the standard is called IAS 20. The third examiner, IAS 20. We call it accounting for government grants and disclosure of government assistance. You see the storyline? And disclosure of government assistance. You see, here we are interested. This standard, as usual, was issued in 19, in fact, where government, Ghana has the West famine, 1983. That's when these standards came to be. It basically prescribed how we should account for government grant and disclosure of government assistance. So you see, if I should summarize this for you, from the topic, it is government grant that we account for. So we account for government grant whilst we disclose government assistance. That's all. Take notice of this. So we do what? We disclose government assistance and we account for government grants. Now, what will be the objective of this standard? As usual, the objective of the standards, and then we go to scope. The objective is to prescribe the correct treatment or the accounting treatment of grant and assistance. Can we add aid? All of them form parts of government grant. So the objective of this standard is to prescribe the accounting treatment of what? Government assistance and government grant. So that is the main objective. Good. So now we are going to look out for first. Let's look out for in fact, I've talked about the objective already. Now let me go to scope, the coverage. Let me do that one on next page. Does it cover all forms of assistance and all forms of grants? No way. There's always exception. So the scope, the third examiner that government grants applies to, the standard shall be applied when accounting for and disclosing government grants and then the assistance. But it does not except, so take the third examiner. So it applies to all government grant and assistance, except, know the exception. Number one, especially my final year final level student, please, the sections are so important to you. The examiner could set a lot of issues out and you'll be asked to account for the transaction under that method. In that case, you must know where this standard starts, where it ends. Good. So first thing, except for if government participation in the ownership of the entity, please. If government owns, so let's say government participation. Government participation in the ownership of the entity. So if government owns shares in the entity, please, we cannot apply government grant. So you see, government own some of the industries in the country. If such situation occurs, government grant, IAS 20 can never be applied. We just want to have a neutral ground where government is not what? It's not a part owner of the entity. And then except for government grants covered in IAS 41. So take note, number 2. So except government grant covered in IAS 41, agriculture. So there's a grant or assistance to agriculture. In that case, IAS 20 could not be used. And then we move on with the game. Now, there are many of the exceptions. So government assistance in a form of what? Taxable profit or tax loss, or let's say like tax savings or tax credit or tax allowance, please. We don't talk about it. So number 3, government assistance in the form of tax allowances, all these are exempted. Now, let me define certain terms for you. They are very important. Over here, you must know how to define 3 things. What a wow. I will define 3 things for you. You must know these 3 definitions. They are very important. What are they? Let's first define government. Please understand government here. Government definition with reference to IAS 20 is not like the way Abraham Lincoln defined government. For the people, of the people, by the people. In fact, plenty people. No. Here, government, our definition for government is that, in simplest language, anyone who can give funds out. So over here, government refers to government agencies, and similar bodies, whether local, national, or international. So let's go. Government refers to government itself, of course. When you say government, so government, meaning national, state, sovereign state, united, in fact, United States, Canada, Ghana, South Africa, Madagascar, all of them are government, right? No problem. And government agencies, yes, government agencies. Give me examples of government agencies. Government agencies, such as what? The district assemblies, the departments, the central governance, any form, in fact, any government institution is government agency. Government, in fact, revenue authorities, all of them are government agencies. Or similar bodies, bodies, third examiner. And similar bodies. Whether local, national, or international. Whether local, national, or international. I'm done. So UNESCO qualified to be what? Government, because UNESCO is an international body similar to what? Government. That is that. So UNESCO qualified to be what? Government, with reference to IAS 20. Now, to make things clear for you, in simplest language, government refers to whether local, international firms or national firms that stand chance of giving. So any entity, whosoever, whether international, national, or local, who can give or who can give out, it's called government. So please, government, we are not interested in just a country, no. With reference to IAS 20, a country is just one form of what? Government. So with IAS 20, UNESCO, World Bank, IMF, all of them are government. Yes. Target Professional Consult, you're also government. Yes, with reference to IAS 20. Yourself, you're also a government with reference to IAS 20. So you can call yourself a government. The government known as what? Target Professional Consult, with reference to what? IAS 20. Because it can be local, national, or what? International bodies. Good. Now let me start from government assistance. I am defining three things for you. You must understand them. Government assistance. Know the difference between an assistance and what? A grant. They are not the same. When you say government assistance, what does it? In fact, it's an action by the government to provide economic benefits specific to an entity or range of entities under certain criteria. That's all. So third examiner, there is an action by government. So assistance simply means an action by government. So an action. So assistance is not a door movement, it's an action word. Assist me. So it's an action by government. So action by government. Please, the government we are talking about is what we have defined up there for you. Not government as in country alone. designed to provide economic benefits. You get that? NGOs, yes, they are also governments. NGOs are governments. Yes, NGOs. IMF and all of them are NGOs. They are not under any country. So they qualify to be what? Government. UNESCO and rest. US aid. Yes, all of these are governments. United Nations, ECOWAS. Mention them. Oh. So with reference to IAS 20, we are not limiting ourselves to just sovereign states. We are going beyond the borders. In fact, they are actually designed to provide economic benefits. You see, specific to an entity or range of entities qualifying under certain criteria. There's nothing for you. Economic benefits specific to an entity or range of entities. Yes. All farmers, range of entities. Qualifying, and like the word qualifying, under certain criteria. So it's not anybody that government assists to. Qualifying under certain what? Criteria. It's not any entity at all government to assist. No, there's a criteria. If you meet that criteria, come for the assistance. If that is the case, then government should assist everybody. No. So there's a condition. There's nothing free on this. Forget about it. There's nothing free under the sun. There's nothing free here. Yes. So at the end of the day, you must do something before government will assist you. You won't be sleeping on bed and government will assist you to sleep well. By reducing light bill and water bill. Like, so happy. Only when you are producing something good. Now, with the assistant, I have to be very clear and honest with you. Assistant does not include transfer of resources. Take notice. A typical example is what? Imposition of trade restrictions. Imposition of trade restrictions. Another example, grant of operating license. Operating what? License. Imagine we're supposed to go through target professional consult. We are producing local rice in a country. And then the government imposed a law that no one should import any foreign rice, not even from where? Thailand. Yes. Not so. The government has assisted a local company known as what? Target Professional Consult to expand. Government has put money inside our pocket indirectly. That is what we mean by what? Government assistance. Again, imagine Target Professional Consult want to produce insulin or want to produce some of, let's say, Duema or some medicine. And we need license from the Ministry of Health Ordinary, it's supposed to take us 6 months to obtain this license. Government said that, wow, target. As a nation, the government is supposed to be the one taking care of the children. If you say you do that, no problem. Let's grant this license within 2 weeks. So in that case, government have assisted our business. That's what we mean by government assistance. It's totally different from grant. So totally different. So know the difference between grant and what? Government assistance. So now let me go to grant. Good. So let me go to government grant. What is government grant? No examiner will ask you this, but there was a question in final level, part 3. The examiner listed a lot of story for them and asked them to explain whether they are grant or they are assistant. Come and see. You see, the examiner did not ask them to define grant, to define assistant. He was just testing their knowledge practically, whether they understand it. So they will give you practical example so that you now decide which of this is grant, which of this is not grant. Now, when you talk about grant, government grant, let me add government to it. Let's go to government grant. When you say government grants are assistance by government. So they are what? They are assistance by government in the form of transfer of resources. That is the only difference. The form of what? Transfer of resources. You see? With a government grant, government must transfer something, a resource, something, to an entity. To an entity in a return for past or future compliance. So it's not for free, please. In a return. In return for past or future compliance. You see, every grant, you must comply with certain rules. Failure to do that, they will call you to pay back the grant. Yes. So return for past or future compliance with certain conditions. Compliance with certain conditions. There's nothing for free except target professional consult videos. The only thing you need to have is what? Is your data. You are free to go to watch. You only need data. Yes. So certain conditions. So please take notice of that. I'm done. So now, in summary, when government give you something, it's a grant. When government help you without giving you anything, it's an assistance. Take notice of the difference. So example, here government will commit, will give you something. So they can give you, example, they can give you cash. They can give you tangible assets. tangible assets. They can give you input or raw material. So imagine the government, you are buying assets and government supports you. It can happen that you are buying, let's say, plants and machinery for your production. And government is saying that, wow, let me support about 20% of the plant cost. Government is giving you something that becomes a grant. But where governments assist you without giving you any form of resources, it's a mere assistance. Take notice of these two differences. The examiner will give a practical case and ask you to explain whether this is a grant or this is what? This is a grant or this is assistance. So me, I have one for you. So take this question, be thinking about it. If government provide technical service, is it a grant or is an assistance? Imagine technical service or training. Government provides free training and technical services, free training. So take notice, be thinking about it. And when your answers are ready, just let me know. Government training, the company staff. And for free, training them for free. They'll come and train you. Where do you think it will be? Well, I've received the first answer, assistance, okay. In a sense that government is not transferring anything. Okay, so training does not amount to resources. Okay. So with the grant, government must transfer something. With assistance, government is not transferring anything, just that it's a helping with its powers, its authority. So technical service or technical assistance and training. What about the training? They are not the same, please. Technical assistance is not the same as training. I'm begging you. Technical assistance is like you need 1 or 2 guidance about how to operate a fish pond. And government have given you guidelines how to operate fish pond. That one is a mere assistance. But where every week, every month, every 3 months, government officials appeared at your farm, training you well. And this training, if you should go and acquire it elsewhere, it will cost you like $10,000. And you are enjoying this for free. Just because you are into what? Just because you are into an area of business that the government like. That is why you're enjoying all this. So take notice of that. So technical service, if you argue that is an assistant, I have no problem with that. What about the training facilities? And that is all. All right, so I'm done. Now let me go straight to the types of government grant that we have, and then move on with the game. We have grant that relate to income. We have the grant that relate to assets, and then the rest. So types of grant, types. There are 2 types of grants. We have capital grant and revenue grant. Because this one grant that relate to assets, grants that relate, or is a grant relating to assets, and grant that relate to what? Operating expenses. Good. Or grant other than, so there are grants other than grants relating to assets. That's all. So these are the types of government grant that we have to know. So I'll take my time and walk you through how we should account for them and then move on. Please, you are aware that for government assistance, it must be disclosed in a book. What are the conditions for recording grants in a book? Very important, please. The mere fact the government have promised you doesn't mean that go and record it in your book. We are begging you, please and please again, the condition, recognition criteria of grant. Before you record grant in your book, certain conditions need to be fulfilled. What are they? So before any entity record grant in the books, certain conditions should be there. If these conditions are not there, please don't have a grant to, we are begging you. If these two conditions are not there, please don't bother yourself to put in there that you have a grant. You don't have any grant, forget it. Just forget about it. It's just a mere promises. Now, government grant, it can be non-monetary. Yes, let me explain this. Government grant can be non-monetary. Government can give you a vehicle. It's a grant too. You need money to go and buy a vehicle, and government have given you such vehicle for free. So government grants can be in a form of monetary and non-monetary. They can give you physical cash to operate, to go and buy whatever you want, or they can give you whatever you wanted to go and buy, they'll give it to you, like a tractor, sewing machine, one district, one factory. So government can give you a factory, can give you a dam, one district, one dam, have you seen? One village, one dam, solar panel, all this, they are called non-monetary grants. Let's go. So before you can record any of these grants, two conditions. But please, the non-monetary grant, it must be at fair value. Take notice. Non-monetary grant must be at fair value. If government give you a car, a vehicle, or a tractor, please use the fair value in the books. That's all. First condition, the standard make it clear that if the entity will comply with the condition attaching to the grant, if the entity will comply with the condition. Condition number one, if the entity will comply with the conditions attached. You see, conditions attaching to the grant. This standard is due for examination. Is due to be examined. So you see, before you can record grants in your books, make sure that you can what? Fulfill the conditions. So if you know you can't fulfill, please don't go and take the money. Don't go and take the money if you know that you can't fulfill. Condition number two now goes to the government. The grant will be received. If the grant will be received. So an assumption that I only record if the grant will be received. If the grant will be what? Received. So please don't be using campaign promises. Opposition party and then ruling government have promised you that, oh, if you retain me or if you vote for me to come to power, hey, when I come, all the company that is operating in the northern sector or the southern sector, All of you, I'll give you one bus free of charge. And then you heard this news. You went straight to the southern part and go and establish a factory over there waiting for the government bus. Oh. This is a mere campaign promise. How sure are you that they will win the election before this will be implemented? Before you will receive your bus. So you only record grant if you are sure, very, very sure that the money will be received, or even the asset will be received, or the grant itself will be received. That's all. I'm done with the game. Let's go to the accounting treatment or the types of grant that we have. So these are the two conditions. If you fulfill them, why not? Go ahead and record grant. A government grant is not recognized until there is a reasonable assurance that the entity will comply and the grant will be received. Take notice of this condition, unless there's a reason. In fact, reasonable assurance. There must be reasonable assurance that the entity will comply with the grant condition whilst the grant will be received. When this happens, you can go ahead and record your grant. Now let's go to the measurement, the valuation of the grant. How do you put them? How do you attach value to your grant that the government have given you? I'm starting from grant relating to income and explain that one. So let's pick grant relating to income. Grant relating to income. You see, government can assist you or take care of your operating expenses. So is the grant to cater for operating expenses of the entity. So grant to support the operating cost of an entity. What's the accounting treatment? That's all. Then I'll go to the other one. We are done. Nothing else, nothing more. Accounting treatment of grant relating to income. Accounting treatment. So let's go to the accounting treatment. I'll do it here. Accounting treatment. The grant should be accounted for as and when you fulfill the condition. So please take notice, as and when you fulfill the condition. That is when you can record the grant. As and when you fulfill the condition, that's the only situation that you can record a grant in your book. As and when you fulfill the condition. Take notice of that. Now, first, when the condition has been fulfilled, so 100% condition fulfilled. So when all conditions are met, what's the treatment? Only two treatments. Number one, you debit cash or receivable if you have not received the funds. Sometimes you have fulfilled the condition, but the money have not been paid. Yes. Ask the chief farmers, the national chief farmers, when they receive their award, when will the funds arrive into their account? Sometimes over a year. So government can award a grant. Yes, you have fulfilled the condition, but the money have not arrived yet. So long as you have fulfilled the condition in accounting, you have every right to record it there as your money. So you have every right to record it as grant. But debit your what? Your receivable. You are yet to receive the money. And credit your income. So you credit grant income. AKA here we are adding to what? Add to other income. It's an income to you. That's all. We are done. So I'm done when the condition has been fulfilled. So when you have met all the conditions, now I left the government to also handle his payment. And then the equation will balance. So please take notice of that. Now, what if the condition has been fulfilled in piecemeal? Partly fulfilled condition. So when only part, only a part of the condition only part have been met or have been satisfied. In that case, what do you do? In that case, what do you do? So only a portion has been satisfied. Only a portion has been satisfied, just a portion. So in that case, one. So at the initial stage, all the funds received should be deferred. So let me do initial treatment. Initial treatment. One, you debit cash, add the money. Add it to your cash because government have given you $45,000 to set up to employ, let's say, 500 graduates over a 5-year period. Once the government gives you the money, debit your cash book or your bank. Let's make it cash or bank. Number two, credit what you call deferred income because you have not fulfilled the condition yet. So credit deferred income because you have not fulfilled the condition. So defer the income. You can never record it as your income. Never. You can't. You cannot record it as your income. Why? Because you have not fulfilled the condition. So hold it as a liability. You owe a government a particular condition. So until you fulfill that condition, you cannot call it. So at the end of each reporting period, at the end or at the reporting date, that's at the end of each period, then the portion that you have fulfilled, the part that you have been, that year you met, that condition that you're able to satisfy, you release only that portion. So in that case, what do? You now debit your deferred income. Then you now credit grant income. With which amount? With the portion of the grant satisfied. That's all. I'm done. Nothing else, nothing more. So for example, imagine that Target Professional Consult receive a grant from the government of South Africa and is instructing us to provide free accounting lectures for, let's say, 500 students. And they give us $100,000 that they are giving us just 2 years or 3 years. So within 3 years, we must teach 500 students freely, or we must help 500 students to qualify or to graduate from whichever institution within 3 years, and you're giving us $100,000. And Target Professional Consult took the grant because it can fulfill the condition. Yes, it took the grant. So Target Professional Consult took the grant from South African government, hoping that they will graduate 500 students across board. So it's like a scholarship, no problem. So let's just assume that in year one, 2, and 3, Target Professional Consult employed 200. They did very well. The second year, they only employed 180. Then the last year, they graduate only 120, making the 500. So here, it's equivalent grant. So we can do some small computation and say equivalent. It's equivalent grant. Let's do the calculation. What's the total? The condition is that you must employ 500 or you must graduate 500. So as and when you graduate, you pick. So at the initial date, when the South African government gave us the grant of $100,000, we will set that 100,000 as what? We will debit cash and they will credit deferred income or deferred grant. It means a liability to us. We owe a government a condition. So when we receive the money, we cannot record it as our earnings until we graduate students. So as and when we graduate the students, we now release a portion. So let's calculate. For the first year, we graduated what? 200 students. So what will be its equivalent? It will be 200 divided by the 500 times what? The $100,000. What do you get? What will be the amount of grant we must record in our book for that particular year? So 200 over 500 times 100,000. So let's go. 200 divided by 500 times 100. So that should be $40,000. So first year, we qualify to receive $40,000. The rest of the money will still be in our liability post. Then the next year, we graduated 180. So that will be 180 out of 500 times still $100,000. So that will be 180 divided by 500 times 100. That should give us 36,000. So you see? So 36,000. Then the last year, we had 120 over 500 times $100,000. And that will give us, this will be 76. I guess it should be 24. So, what if the last year we only employ or we only graduate 100? So in that case, if you graduate only 100, so that means the last year will be like this. The 100 divided by 500 times 100,000. You see? And that will give us 20,000. So that means it still leaves a particular number of students who do not graduate. So in that case, it will be 20,000. That means we should have a liability. How would the financial statement look like? So the accounting treatment will be like this. At the initial date, initial entries, they are A, we debited cash. B, we credited deferred grant. All of them with what? $100,000. $100,000. Then at the end, so at the end of the reporting date, or at the reporting date, comma, what will happen? Let me do the P&L here. Let me do the financial position here. Balance sheet. Now, at the end of the reporting date, let's say year 1, year 2, year 3. You only record grant, the portion that they have fulfilled. So as at the end of year 1, they have only fulfilled $40,000. So you go and write your $40,000 here. Then year 2 is $36,000. So you say $36,000 in your P&L. Year 3, if they are fulfilled all, you record 24. That is all the rest. If they are fulfilled only 100, the 100, its equivalent is what? $20,000. Now you record only 20,000. So take notice of that. So you put in the $20,000 here, and you are done. For the financial position, aka balance sheet, year 1, year 2, and year 3. You see, you record a cash and then liability. So under the asset side, there will be a cash balance of what? 100,000. But under the liability, they're going to call deferred grant, non-current liability, deferred grant. At the end of the period, the grant, you see, they give us 100,000. We have only fulfilled 40. So how much left for us to move? basically it left with what? It left with $60,000. So at the end of the year one, we are still owing government $60,000. Then out of this, we have fulfilled 36. So 60 minus 36, 24. So we are owing $24,000 here. As at the end, we have fulfilled all. As at the end, if it's the 24,000, it means we have fulfilled all. If it's the 20,000, that means we are still left with what? 4,000 to go. That means we were not able to graduate the 500 students. There are some of the students that we've not been able to what? Graduate them. So take notice of that. I'm done with grant relating to income. Let me go to grant relating to assets. And I'll move on with the game. Good. All right, let me go to grant relating to assets. Grant relating to assets. AKA capital grant. AKA capital grant. There are two types of the treatment. We have the deductive approach. Then we have the deferred grant approach. Deferred income approach. Yes. Now, what we have to take notice of is the treatment of these two approaches. And then we are free to go. So take notice of it. Now, I'm not much concerned about the presentation. It's about the computation and then the measurement. That's what I'm keen about. So this one is the deferred income approach. So these two, all of them give the same, they give the same final answer. They result in the same financial position. So the final answers are the same. So have the same what? Same final results. Take notice. And then move on. Final level. You must consider what you call repayment of grants. At what point can government ask you to repay the grant? May 2017, question number 2. No, November 2017, question 2. Repayment of grants. I see. It's your travel. Now let me start. Deductive approach. This one, I will not solve question. Deductive approach. Or method. Here the entire grant is subtracted from the original cost of the asset, and the remaining balance is what? Depreciated. That's all. So example, let's go. Cost of plant is $100,000. Grant, government gave a grant of 40%. Government contributed to 40% of the grant value. So how would the treatment look like? And then we are done. Now let's start. Now, so solution. 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 Third examiner, cost of the asset. Let me view where's the case. What if there's a scrap value? Yes, scrap value. I just want to where's the case. Scrap value of the asset. The scrap value of the assets. Yeah, let me remove the scrap value for now. Let's make it just $10,000 after 4 years. So the asset life is 4 years. Start. Asset, cost of the asset in dollars is $100,000. Grant received. When you say grant relating to asset, government, either government giving you the asset itself or government is supporting you to buy your asset. Whichever be the case, government is transferring something to you. Either it's giving you fiscal cash or it's giving you assets. And then that is it. So grant received. Do your computation for me. What do you get? 40% times 100,000. What do you get? Yeah, that would be $40,000. So finally, what will be the net amount? 60,000. So on which depreciation will be levied on? So let's calculate depreciation. Depreciation will be calculated as the 60,000 cedis minus the scrap value of $10,000 all divided by 4 years. What do you get as your final answer? 50,000 divided by 4 should give us $12,500. Good, $12,500. That's all. Now let's provide the accounting treatment. How the P&L look like, how the balance sheet look like. With this, the grant itself does not enter the P&L. Take notice. Just follow the storyline. So here, let me do the P&L. Let me do the comprehensive income here. Comprehensive income. Let me do the financial position here for you. Let me do year 1, year 2, year 3, and year 4. Year 1, year 2, year 3, and year 4. Depreciation is going to be $12,500 for each of the 4 years. Let's go to the balance sheet. Here, no grant. Grant will not be featured in here. Now, with the balance sheet, what do you think will happen? You record cost of the asset. Who can tell me the cost of the asset? What do you think will be the cost of the asset? Will it be 100,000, 60,000, or 40,000, the cost of the asset? The cost of the asset, what should be the value? Now, the cost of the asset should be 60,000 because, so it should be 60,000 throughout. It's no longer 100,000. The 100,000 vanish from the books. Take notice that 100,000 vanish from the book. So $60,000. Now, help me with the accumulated depreciation. Let's go. The accumulated depreciation will be, first year is $12,500. Second year will be accumulated depreciation. Second year will be 25,000. Third year will be, then the last year will be 50,000, right? What's the carrying amount of the assets? So year 1, what will be the carrying amount of these assets? What will be their carrying amount? CA, carrying amount, chartered accountant, come again. Yes, that's the full meaning of CA. Okay, so 60,000, you get 47,500. Then this one will be 60 minus 25, 35. Now 60 minus 37,500, that should give us 22,500. The last one is 10,000, right? Please, the 10,000, it represents the scrap value. The last year, 10,000 is the scrap value. I am done. Let me go to the next one, and that's all. You see the grant. We'll finish grant right now. Just the next few minutes, we'll say bye-bye to grant. Yes. We'll say bye-bye to what? IAS 20. That's all. 11 questions solving. Now I'm done. Now let me go to what you call the deferred income approach. So deferred income method. With that, the entire grant is deferred. So first condition, the asset is depreciated on the original amount. Second point, the entire grant is deferred and amortized over the asset's useful life. Over the asset's useful life. That's all. I'm done. So let's go to the how the P&L look like. So I'm going to draw how the P&L look like. So this is the comprehensive income. Please, with this, the entire grant becomes what? A non-current liability. And every year, a portion is released. You amortize it over the asset's useful life. Every year, a portion is released. Every year, a portion is released. Every year, a portion is released. That's all. So take notice of that. Now, so the asset will be depreciated on the original value. What's the original value of the asset? Original cost of the asset is 100,000. So here we are depreciating the 100,000. What a wow. So please kindly calculate the depreciation, this comprehensive income. Calculate the depreciation for me on the original. So depreciation will be, let me do it here, depreciation. It's equal to 100,000 minus 10,000 over 4 years. What do you get? 22,500. Yes, I'll take that. Then you amortize the grant too as well. So amortization of grant. You divide the entire grant over the asset useful life. So what do you get? It will be 10,000 per year. Now there is I want to subtract one. Which one should I subtract? Oh, depreciation is an expense. So let me subtract depreciation. Good. Now let's go to the financial position, aka balance sheet. Year 1, year 2, year 3, year 4. First, let's start from the asset cost. their cost will be originally 100,000. Their cost will still be 100,000. Then accumulated depreciation. The depreciation is 22,500 for the first year. The second year will be how much? 45,000. It's what about the third year? And someone is also doing the fourth year. And someone is also giving us the current amount, please, so that we end early. The third year will be how much? 67,500. Then the last year will be 90,000. Yeah. So let's find the current amount of the asset. Let's go current amount. First, okay, so that will be 67 or 77. 77,500. Next, 55,000. Next, and thereafter. Is it 35,500? Is it correct? 35,500 or 32? Okay, so 32,500. The last year is 10,000. Now we are done with the first half. Let me go to the second half. That's the most challenging aspect. Now, the most challenging aspect is the liability aspect. So right here, non-current liability, under it, write deferred grant or just write grant. And come and write current liability, under it, write grant again. Let me explain. The entire grant will be deferred. It means that it's a liability. The entire grant will be deferred. It means that it's a liability. And every year, a portion will be released to the income statement. Every year, a portion will be released. Every year, a portion will be released into the income statement. So the question is, when a year is due and that portion that you released, it reduces the liability. So follow, please follow like this. Let's start the mathematics. What is the entire grant so far? The grant was $40,000. Now, at the end of year one, how much of the grant have we released? At the end of year one, come here, here is it. We have released 10,000, this is it. So how much left? The entire grant. The grant was 40,000 and we have released 10,000. How much left? How much of the grant left? Did you all agree that left with 30,000? Because the grant was 40. The grant was 40. And now what happened? The grant was 40 and we have released the first year's own. So left with 30,000. Now, this 30,000, the portion that we are going to release next year is a current liability, because current liabilities are debts that need to be paid within 1 year. So those that we have to pay next year should be, or no, those that we are going to release next year becomes current liability. How much are we going to release next year in year two? We are releasing what? 10,000. So that becomes what? 10,000. Now, if the entire this is the total liability. If the entire liability is 30 and 10 representing current, what will be the non-current aspects of it? Ideally, that should be the balance, right? So what will be the non-current liability aspect? That would be what? 20,000. Please, here is a bit dicey. The total debt or the total liability, the total is 30,000 at the end of the period. 10,000, which will be yet to be released next year, becomes what? That one becomes current. And the remainder becomes non-current. That's all, we are done. Then, when you go to the next year, year 2, so far, we have released 10,000, 10,002. So how much left as the total liability? Left with 20,000. Now, as of the 20,000, 10,000 will be released next year. That becomes current liability. The remaining balance is 10,000. That is what we have to release next year. Then at the end of the year 3, we have released what? 3 of the 10,000s. And that will give us 30,000. So at the end of the day, the total liability left is 10,000. Actually, that is the one we have to release next year. And here become dash. The rest dash. And then dash. That's all. Please ask questions. No matter which formula you use, the final answer is the same. Now, if I have assets of 22,500, this which side? Does it sound confusing? Yes, this side is a bit dicey, so you go over and over and over, and then you surely get it. The entire liability. Yes, with the liability side. When we started like this. This is how we started. We said that what is the entire grant? 40,000. Entire grant is 40,000. How much have we released this year? Take notice. The entire grant government gave us was how much? I want everybody to follow. How much was the entire grant? The entire grant, how much is it? The entire grant government gave us. How much? Government gave us 1, 2, 3, 4. Government gave us 40,000, right? Yes. And this year we have released 10,000. So how much left? We have fulfilled 10,000 out of the 40,000 conditions. So how much left? It's 30,000. See, this 30,000, we should have just recorded this 30,000 as a liability. That's why it ends there. But because of best practice in accounting, we have to break this liability into two, current and non-current. In fact, that confuses a lot of people. So probably in exams, you may lose certain marks, but you can decide to work them as liability without demarcating the current from non-current. This 30,000 represent the total condition left to be satisfied. The total grant yet to be what? Released. Out of this 30,000, a portion represents current and another portion represents what? Non-current. So tell me the current. The current is the one that we are going to release next year. So the question is, how much are we going to release next year? We are going to release 10,000. So we have to release 10,000, right? Is it true? Yes. So if you are going to release 10,000, that becomes a current liability. So now, whatever we are to release next year become a current liability. Do you get it? So now, out of the total liability of what? 10,000. Total liability of 30,000. 10,000 becomes what? Becomes current. what will be the non-current aspect? What will be the non-current aspect? What will be the non-current aspect? That's the remainder, 20,000. Then you record it, 20,000. Then when you go to year 2, so far we have released what? We have released 10, 10, 10, 2 in 2 years. So it becomes 20,000. And the grant itself was 40. So now 11 total liability of what? 20,000. Again, we are going to release 10,000 next year. That becomes current liability. Remaining balance, which is the 10,000, becomes what? Non-current. Then in year 3, we have released 10, 10, 10, 3. So making 30. So the balance of the grant is what? 10,000. And this 10,000 released next year, that becomes the current liability. At the end of the day, we are done. And everything must be the same. These answers are the same. If you like, check. Here, the final answer is 12,500. And then it's an expense. This depreciation is an expense. Expense. If you come here to, we have a depreciation of 22,500 and a grant of 10,000. So the net depreciation is what? It's not 12,500. Yes. So the question is, whichever method you use, the answers are the same. What a wow. Now let's come to the asset side. Year 1, they have asset of 47,500. That's it. Can you also get the same thing here? If we have a non-current asset of 77,500 minus a total liability of 30,000, what do you get? So 77,500 minus 30,000 should give you the same answer as 47,500. And if you follow the same pattern like this, you get all the answers the same. On that note, I'm done with the computation. Now I left with few issues. Repayment of government grants. Sometimes the grant becomes repayable and shall be accounted for as a change in accounting estimate. Please, IAS. Anytime grant becomes a repayable, you have to use a change in accounting estimate. The repayment of a grant relating to income shall be applied first against the unamortized deferred credits. Yeah, that's in respect of the grant. That's what we are trying to say. So, repayment issues. Repayment came in November, ICA. So you have to solve. So far, it has only dropped once. So I'm done with grant per se. So I'm solving only 2 issues. Then I'm done with grant entirely. The first one I'm solving is called repayment of grant. Know the issues. Repayment of grant. First, if it is revenue grant, so first the repayment should be charged against the deferred, the unamortized deferred credit. So first, the repayment is charged against unamortized deferred credit. Unamortized deferred credit. Again, to the extent that the repayment exceeds any such deferred credit, or when no deferred credit exists. Now, the repayment shall be recognized immediately. Yes, immediately in a profit and loss. So where the unamortized value is lesser, that one, to that extent, the difference. Imagine you have unexpired amount of 20,000 and government said this is unamortized grant. It means this grant is still sitting in your books. You have not touched that money. But government have asked you to pay 25,000. Then it means that there's a loss. You charge 5,000 to your P&L immediately because there's a loss. You are paying much more than the unamortized grant balance that you have. So basically, that is it. Now let's go to the grant relating to assets. That one, we'll do the calculation. Grant relating to assets. So capital grant, how do you do that? You check ICA November 2017 part 3. Question number 2. That's level 3. Corporate report. Now, over here, if it relates to assets, repayment of grants relating to what? Assets. Take note. On reducing balance or the deferred credit approach, you see, there are two ways of valuing assets. Don't forget that there are two ways. All what I'm trying to say is that if there's a repayment relating to, let's say, an asset, it shall be recognized as increase in carrying amount of an asset or reducing the deferred income balance. Yes. An additional cumulative depreciation must be charged. Please take notice. I will record for this. When I'm solving calculation question, I'll record these 2 points and I'll ask you. First of all, the repayment shall be used as what? The repayment shall be an increase in the carrying amount. So add it to the carrying amount. Increase in carrying amount. Number 2, grant a cumulative depreciation. Then you charge what? A cumulative depreciation. You are done. You charge cumulative depreciation. So you charge cumulative depreciation or additional depreciation. And you recognize it in a P&L, profit or loss, and then that's all. So take notice. Good. So at the end of the day, I'm done. That's all. The last thing is the disclosure requirement. Then we end it. So please try your hands on November 2017 level 3 past question. I think I've solved it on the YouTube there. I'll look for the video and add it to the link. You click on it, it takes you there for the solution of that particular question. Now, disclosure. You must, one, disclose the accounting policy adopted for the government grants and then the method of presenting. So accounting policy adopted for the grant and its presentation. Disclose that. The nature and extent of government grants recognized in the financial statements. So here you disclose the nature of government grants. Number 3, you have to disclose what we call unfulfilled conditions. Yes, the condition that you think you can fulfill, unfulfilled conditions. You might disclose unfulfilled conditions. I'm done. That's all. So please, if I solve one question under this, there's no problem again. On that note, you are done. But let me just use 5 minutes to scan through some critical question, very important question here. And then you try your hands on them for me. Very critical, very important. Very important. Let me see. Okay, so here's it. Let's go. Then all the questions, they are here now. Now take notice. So let me and watch careful how they ask the questions. How they will probably ask the questions. So IAS 20, IAS 20, and IAS 20. IAS 20. Good. Let's go. First question on the list. This is corporate reporting exam questions. Detail the requirements of IAS 20 in respect of government grant aid capital expenditure. Capital expenditure, that's capital grant. There are 2 treatments. Either you select the deferred credit or deductive approach. That's all. Then you explain how you should treat them. I don't think this is a problem. So don't worry. Let's move on to the question I'm looking for. Dodowa Limited, yes. It's also this is a repayment. This is the question I'm talking about that you have to solve. This one was a repayment of grant. This question is November 2017, question number 2A. So that's where the grant became repayable. The government asked them to repay 10% of the amount. Don't forget the treatment. The amount they will pay will be an additional carrying amount. You grant depreciation on cumulative basis. And that's so there's a particular question I'm looking for. And I found that one. I'll be very happy. Okay, so that one is not yet in here. and remove. Which of them is assistance? Is it FR2? Let me check FR. Okay, so here we go now. Here we go now. Now, check this question careful. You see, this one is which? This is Dambai. During the year, Dambai decided to relocate some of its other operations to a regional development area, which offers attractive labor costs and tax incentives. The regional government agreed to contribute 200 as a result of Dambai setting up in the regional development area. There are no particular conditions as to what the money should be spent on. The cash was received 1st of August 2019. Detail. So explain how the financial statement should be treated, how they should treat the above in relation to IAS 20. This one, is it a capital grant or revenue grant? Setting up a company, capital grant or revenue grant. If you are setting up a company, this financial reporting question. All those that we saw earlier was the part 3, this part 2 questions. So this is a typical capital grant. Setting up operations. Or we could argue strongly that the revenue grant, because they didn't tell us specific, yes. There are no particular condition as to what should the money be spent on. Then if that's the case, then the money should be on what? A revenue grant. It means that it's for operations. So as long as you have set up, you are free to go to record it in the books. So they should record it in the other income. They should debit cash and credit other income. That's all. You are done. Nothing else, nothing more. Because they've earned it. So long as they've set up, they've earned it. Yeah, so that would be a revenue grant. So please, it must be treated as what? Revenue grant. There's another one too here. There's a lot of story. And they ask them to do it. Okay. Okay, so in accordance with IAS 20, accounting for government grant and disclosure of government assistance, distinguish between government grant and government assistance. 2 examples each. What a wow. Please, what's the difference between government grant and government assistance? 2 examples each. Give me 2 examples. I wish like we define it, we give examples. The examiner is asking you to define government grant. Distinguish. The underlying factor is that 1, there's no transfer of resources. 1, there's transfer of resources. So create your own example where government is transferring several resources to an entity. You can say debt forgiving is a grant. Debt what? Forgiving. You owe someone, the person say, I'm forgiving you, HIPIC style. It's a grant. That is it. And a reduction in interest rate is a grant. You probably, that one, all this are capital. You see, we can refer to this debt forgiving, they are grants. Reduction in interest rate, you went for a loan. They're supposed to charge you 25, but because the government know you well. They charge you 15. You are saving 10%. It's a grant. And all these, they've had questions on them. Several questions on them. And let's go to the next one. So try and give you examples. This one is capital grant. You see, they bought a plant. The company received 2 separate grants. Please, tax waiver is assistance, not a grant. I like that. I like your question. Tax waiver is never tax waiver, tax allowance, those deferred tax, reduction in taxes, tax allowances. Please, those ones are not what? They are not grants, they are assistance. Take notice of that. So now let's continue with the storyline. So the company received 2 separate grants during the year from United Kingdom government. The first grant, an amount of 500,000, was given to acquire electricity plant. While the second grant of 50,000 was to support training of electrical engineers. Thank you. So that's when I told you that training, when government provide training service to you, that one is a grant, not assistance. But when government provide technical support, it's assistance. Take notice of that. Now, obviously, this one will be a revenue grant, while the 500 will be a capital grant, and the useful life of the plant is 25 years. Here, adopt. Sometimes they will tell you the method that the entity use. Here, they didn't tell us. So now, I adopt any of the 2 methods, whether the deferred approach or the deductive approach. Adopt any of them and do the treatment. That's all. You are done. Nothing else, nothing more. You are done with this question. You see? Very, very interesting. This one, we've done this one. This one. Look at this one. Bosco Aluworks had been awarded a grant of 80,000 to receive over 3 years in respect of what? Providing employment to fresh graduates in the area. Automatically, this is a revenue grant. And once they've earned it, straight to the P&L. The grant number 2, Bosco Aluworks Limited received 5,000 grant from Ministry of Business Development for initial training of new employees. That also becomes what? Revenue grant. The last one, the company also received a grant of 120,000 from Ministry of Special Development Initiative towards the acquisition of 600,000 machine. The machine has a useful life of 8 years and estimated residual value of 60,000. Depreciations on straight line basis. That's all. So, how each of the grants should be accounted for. You do a computation for us. I don't think this should be a problem. So please, you can take a screenshot of all these questions, and then once you are free on your spare time, you go through them. If you have any challenge, don't hesitate to draw my attention, and we move on with the game. Okay, we've talked about Dambai already. Talk about Dambai. So basically, that's all. We are done with the storyline. All right, so on that note, I can say that we have 100% finished with the government grant IAS 20. The summary point is that we only account for grant and we disclose government assistance. So sleep with this quote. Account for grants and disclose assistance. That's all. Account for grant and disclose assistance. Account for grant, disclose assistance. Account for grant and disclose assistance. I'm done with these standards. Government grant. Now, there are a lot of questions. For the final level, please focus on the combinations they can add this to a lot of standards, or the repayment. There are several examples on repayment of grants, and then you are free to go. On that note, I'll probably want to end here. And thank you so much for coming. Please don't forget to share the link and then invite all your friends. Let them do the registration. Please, if you have not registered, kindly register. Please, if you have not registered.